Okay, so let's get through question 21 to 25. These are some very good questions on testing you on the on the mix and yield variances and that sort of thing. So really, please make sure you go through these and pay some attention to what's going on over here. Right, so let's jump into it. So I hope you've read all the information. You have all these standard figures given to you, and you have some other standard figures given to you. So the first question says, what is the material mix variance? I'm just interested in the mix. It's important. So the question here is, you have used 85. So here you've done 35,000 and 50,000, and a total of 85,000. I'm just going to change my pen color. I'm literally interested in if you stuck to the mix as we agreed. And so the mix, in effect, was, this is for A and this is for B. So you were supposed to use, if you're using a total of 85,000, you were supposed to use 5/8 and 3/8 of that to make this product. That's what you should have used. And that gives us a figure of 53,125, and here we have 31,875, and that's still the 80,000. So this is the mix you should have gone with, and this is what you did. So here with A, you have used more than you should have by 18,125. So this is adverse. You have used more. So you've used more. You were supposed to use 35,000 kilograms, but you have gone along. No, sorry. Let me be careful. Stop weighing. This is what you actually used. This is what you should have used. So you should have used 53. You've used 35,000. So that's the difference is 18. The difference between this, of course, and this is 18,125, and you have used less, so that's favorable. And here you should have used 31,875, but you've used 50,000. So this is 18,125 as well, and that's adverse. So the question is, we just need to cost it, don't we? So here we have 18,125 at £25, 18,125 at £22. In effect, we have a favorable here of 25 and an adverse of 22. So really, we have overall, right, a favorable of £3. I mean, you could work it out, but really, it's the difference. It's the same number, isn't it? 18,125 times 25 minus 18,125 times 22, which is 18,125 times 3, and that takes us nicely into 54,375, and this is favorable. So overall, you have a favorable variance over there. Great. So that's that one. So again, it's about the mix. So the mix, keep the total constant and just find what the mix should have been and compare that with what you actually did. All right. Okay, great. So the yield. So we've done yield already. And so the argument here is that we expect you. So the question here is, the idea is that you need, again, I think you just want to be flexible with the way you think about this, and then you just get better at doing it. Ultimately, we expect you to use 8 kilograms to make 1 unit. So given that we expect you to use 8 kilograms to make 1 unit, but given that the cost figures you have are for the actual input and not output, it's always better to go, well, therefore, I expect it's almost working backwards. So, I mean, again here, given that this is the standard, if you are making 9,000 units, right, therefore, for 9,000 units, you kind of expect them to use 72,000 kilograms. That's what you're saying. But the question here is that to make 9,000 kilograms, because that's what they did, to make 9,000 kilograms, they ended up using 85,000. They ended up using 85,000 kilograms. And so we now have a difference, if you like, of 13,000 kilograms too much that they did use, and that means this is adverse anyway in terms of yield. So too much went in just trying to come out with these 9,000 units. How do we split this? According to the standard mix. The standard mix, that's the best we can do. So I have 5/8 and 3/8 times 13,000 times 13,000. My focus now is on yield, so I just want to understand in terms of, it's really about output in effect. So I have 5/8 times 13,000 times, if you like, the the input cost. The input cost is 25 here and 22 here. So I have 25 here and I have 22 over here. And that's how we deal with that. So I have 5 divided by 8 times 13,000 times 25. And then you have here, this bit here is 203,125. And I do the same thing here. This is all, they're both adverse. So I can already, well, I should actually do the full thing. And then I have here 3 divided by 8 times 13,000 times 22. And that's 107,250. Add the two of them together and you get this thing here of 310,375 adverse. And that's that. Now, this question asks about the sales volume. We have already looked at sales volume variance. I've always said, draw the graph. Draw the graph. This question tells us that you're making a contribution. That's the contribution of 158. And your plan is to sell 10,000 units. That's the plan. You end up selling 9,000 units. This question is just asking about the sales volume. That's the volume, 1,000 units less than you plan to sell at this contribution, which brings you to 158,000 adverse. Just draw your graph, clearly eke out what your contribution will be. Look at the volume change, and you're there. And you're there. Great, and that's that. Right, so this question pulls us into this idea of planning and operational variances and this idea of revised standards. Let's look at this. I'm just going to draw a line just to show you what's happening here. The plan, right, was to sell the plan was to buy direct material A at 25. The plan was to buy direct material B at 22. That was the plan. Change my pen color. But now what happened was, this was the plan. This was the initial standard. Then what happened was we went to market and we've been told now that the general market price has been revised to 21. And this has been revised to 19. So prices have actually fallen when we actually get to market. So technically this is what's referred to as the revised standard. But this, you have no power over this. This has just happened. So we refer to this as a planning variance. I mean, that's the planning variance. That's the new standard, if you like, that we now need to work with. And this is the difference, which is a planning variance. Now we ask the question, well, what actually happened? What did you actually do? Well, you actually ended up buying the product for, how do I know how much you bought it for? Well, I'll just come back here. You bought 35,000 kilograms for 910,000. So 910 divided by 35 gives me how much you actually paid for this thing. 910 divided by 35 is 26 here, and 1050 divided by 50 is 21. So you actually paid 26, and here I have 21. So my operational variance, which is the actual trading variance, is the difference between your revised standard and what you actually paid. That's the actual operational. Revised standard and what you actually paid. So 26 minus 21 is 5. How many units did you actually buy? I bought 35,000 units. Kilograms, forgive me. And here we have 2, which is the difference between revised standard and what you actually paid. 2, and I believe you bought 50,000 units here. Let me just confirm. Yes, 35 and 50. And when you do this here, you get 175,000. I mean, this is you bought more, you paid more than you should have, so that's adverse, isn't it? So that's that adverse. And here you paid more again than you should have, so of course there's adverse as well of 100,000. 2 times 5, 50,000, and that's 100,000. And that brings us to the end of that. So that's how we work this out. So again, with these ones, with the operational is what the actual trading, the actual act of buying. Planning is well, there's nothing you can do about it. It just happened. In a way, what's the revision? As you can imagine, we ultimately want to separate this so we can know whether you took advantage of any changes or if the changes weren't entirely due to you. We're just trying to break down variances in effect. And that's how we deal with those operational and mix and yield. So good area to practice and work on. It probably will come. See you in the next 5.